So Austin, we get this question often. What things go into my loan that determine the cost of my PMI?
Yeah, it's a great question, and PMI is a great tool. So depending on how much you're putting down and which loan program you're going with, you're going to have PMI involved. So if you're putting less than 20% down on most loan programs, you're going to have PMI. So let's jump into it straight out of the gate. Loan program is a big factor. What we're covering in this video is not the different types of PMI and how you should set your PMI up. This is strictly what are the universal truths that affect all types of PMI so that you understand how to optimize it to get the best pricing for you. So first is loan program. So we're talking, is this a conventional loan? Is it a jumbo loan? Is it a government loan like an FHA or USDA loan? Those become MIP. Sometimes instead of PMI, same thing though. So loan program, that's a big factor.
Yeah, so loan program can change the cost of your PMI in a nutshell. So this next one we have, Austin, is occupancy. So what are we talking about there? Who you're living with, married, not married? What's occupancy?
Nope. Occupancy is how are you occupying this property? Is this a place you're going to live in as a primary residence?
Gotcha.
Is it a vacation or second home, or is this an investment property? We have PMI available for all of those.
Gotcha. So typically with an investment property, PMI would be higher because of the occupancy type. And typically with the primary residence, you'd have lower PMI.
Yep,
right?
That's exactly right.
Gotcha. And so the next one we have here is down payment. So what we're talking about, dollar amount or what? What are we talking here?
Good question. No, we're talking about percentage. So what is the percentage of the down payment compared to the purchase price? Is it 5% down, 10% down, 15%? The PMI, usually for conventional loans, is going to improve on increments of 5. So over 5%, over 10%, over 15%. You're going to get better and better pricing.
So more down payment, more better for your PMI.
For the PMI, that's
gotcha.
Right, usually.
And this one, we have this DTI acronym. So what is that?
That stands for debt to income ratio. So depending on your mix here, the DTI may or may not make an impact on how much your monthly PMI is.
Gotcha. So, but normally the higher your DTI might be more expensive.
Correct.
Vice versa, lower the better. And the next one we have here is loan size. So we're talking about small, medium, large. What are we talking about there?
Yeah, so loan size is a big one because especially for conventional loans, well, really for all PMI, the actual cost is going to be driven by the loan size itself. So
the dollar amount.
Yeah, the more you're borrowing for your mortgage, the more expensive your PMI is going to get. So all these other factors go into calculating what that percent is. The loan size isn't going to affect what the percent of your PMI is. It's the thing that percentage is multiplied by to calculate the actual dollar amount. So the more you're borrowing, the more your PMI is going to cost, period.
Gotcha. So yeah, think about, borrowing $500,000 versus borrowing just $100,000 can have way different PMI costs.
You might have the same PMI rate, but
way different
cost a lot more.
Gotcha.
Exactly.
And our good friend, Mr. or Mrs. FICO here.
Yeah, that's not your neighbor's dog. This is your credit score. So the credit score, the qualifying score for all borrowers involved in the file, that is going to drive the rankings for your PMI for conventional loans. FHA, the government stuff, there's some programs out there where the FICO doesn't matter or doesn't matter hardly at all. But for conventional PMI, it's a big, big factor. And so the better your credit score is, the better your PMI rate is going to be.
Beautiful. So that's why having a great credit score is important.
Yep.
And this last one we have is loan term. What are we talking here? Short term, long term? What are we talking?
We're talking 30-year mortgage or less.
Gotcha.
So 30 is most common, and so that's how most PMI is set up. But if you're taking out a shorter mortgage, there may be improvements on your pricing based off of how short that loan is going to be. So maybe it's a 20-year note or a 15-year note. You might get increased improvements on the pricing for your PMI.
Beautiful. So those are the things that go into affecting the cost of your PMI. And a great thing about Network Funding where we're at is we have multiple private mortgage insurance companies that we work with. And so when you send a loan our way, we shop around, our system finds the cheapest provider. And then as a great LO, we can try to optimize some of these things to get it down if that's important.
If you're right there on the cusp for a certain threshold, understanding these things we're always on the lookout for not just improving your mortgage terms, but also your PMI terms. So if you've got PMI, that's a big part of your monthly payment. You want to keep an eye out, make sure you get as low as possible.
That's the game. All right, guys. See you later.
If you have any questions, you know how to reach us. Adios.